Finally, that brings us to our third play with the Bollinger Bands. We call it the reversal. Now, you know, Bollingers are really great for showing various phases of the trend. The squeeze play helps us at the beginning. The trend tray helps us at the beginning and during the middle of the trend. The reversal is really great because it helps us see when that swing and when that trend is coming to an end. Now, what's interesting about the reversal is a lot of people dismiss this picture that we see in the Bollingers, but oftentimes if you use it right, it can actually be one of the most profitable trades because it can provide one of the greatest risk rewards. So let's see what we're talking about here. So as we think about the reversal trade, the easiest way to think about this is it anticipates a trend reversal, both a swing reversal and a full-on trend reversal, and it provides one of the best opportunities for a high risk reward trade. Now here's a distinction for you. With the reversal trade, we are selling weakness at the upper band and we are buying strength at the lower band. This is a distinction that's different than the squeeze and the trend trade. With the squeeze and the trend trade, we were buying strength at the upper band and we were selling weakness at the lower band. Here we're flipping it upside down. We're selling at the upper band and we're selling when there's other signals that are telling us it's weak, and we're buying at the lower band when, again, there's signals that are telling us that it's strong. Now, what kind of signals am I talking about? Well, it could be fundamental signals. More likely, the one I like to use is your oscillators. So I will typically use a stochastics oscillator to help confirm this, but you could use other oscillators as well, which we'll look at here in a few minutes here. So let's look at some rules for the reversal trade. At the tag of the upper band, when the trade gets up to the upper band, we're looking to short, or in other words, to go bearish. So you could short the stock, or you could buy puts, you could do any other type of a trade you want. That's a bearish trade. But at the upper band, you're looking for a bearish trade, and here's what we're looking for. We're looking for your percent B to be diverging down. There's a distinction right there. We're diverging bearish there. And we also are looking for your stochastics or some other oscillator to be overbought and crossing down. Again, that's a distinction that we've not had with the other trades. And then finally, here's what we want to do. We want to enter on the first strongly bearish day following this setup, and then flip around, turn around, set a stop on your parabolic. So notice this is a totally different picture than what we've looked at for the squeeze and for the trend trade. Now this is the bearish setup. Let's look at the bullish setup. The bullish setup is going to be a tag of the lower band. So the trades come down, it tags the lower band. We're looking to buy or to enter a bullish trade, whether that be buy calls, do a bull put spread or any other kind of a bullish trade here. But we're looking to enter into a bullish trade. Your percent B should be diverging up and your stochastics oversold and crossing up. And then finally, we're going to enter on the first strongly bullish day, and of course flip around and set a stop based on your parabolic. Now I specifically tagged the stochastics as one of the indications to help confirm this trade. I've done that because most of our viewers here are going to have already a basic understanding of stochastics, first of all. Secondly, it's one that I really like to use, and it works really well. You can use other signals as well. If you find a signal with a MACD that you like, I find that one lags a little bit more, but if you find one that you like, you could use that. Maybe you like the commodity channel index. Any of the good oscillators that give you good overbought signals, if you see them setting up with this setup, you could replace that stochastics chunk with it. Also, you could use this with some fundamental analysis. If you see strong fundamentals and you're at the lower band and you see some of these signals setting up and the fundamentals are really strong, that's a great buy opportunity. Or vice versa, if you're at the upper band, you see some of these signals setting up and you've got really weak fundamentals, that would be a good shorting opportunity. Really, the idea here is that you're buying at the lower band when you've got a lot of strength showing up, and you're selling at the upper band when you've got a lot of weakness showing up. However you come at that strength or weakness, whatever you use to get there, that's going to be up to you, and you can plug that into your own trading system there. Let's take a couple of examples and notice what we've got. Notice that we were pushing outside the band. You see it looked very strong, and then it starts to come inside the band, and look at the confirmation we've got. Your percent B is diverging down. So this is a natural setup here. Your stock is going higher, percent B is diverging down, and we're overbought, crossing bearish on your stochastic. So we want to short on the first strongly bearish day, which was this black candlestick you see on the right side here. and you want to cover your trade or exit the trade at the lower band. That is the reversal trade. Now in this setup, the reason it becomes such a profitable trade is it has a good risk reward. You're getting in at an extreme and you're trading to a specific target. So look at how this worked. If we use the whole system that I just shared with you, use your parabolic stop. You see that little dot right there? Every one of your charting software should give you the dot in the same spot. And when you see that dot, that's where you're going to set your stop right there. So in this case, that stop would be at 71.14. Our entry was about $68. Our target, 61.16. Now, this target, when we got into the trade, would have actually been lower, but of course, those bands are coming closer and closer. So when we finally got there, it was 61.16. And so had you done this trade with those entry and target and stop setups there, our risk reward would be $6.84 to a $3.18 risk. That's a little bit better than a 2-to-1 risk reward. If you do that with a put option, that's going to work out really, really well. You can do it with a stock trade as well. There's a lot of ways you could do this, but the idea here is it's a good risk reward trade. It's a high probability trade because we had that weakness at the upper band, and that sets you up for the trade to reverse and to go the opposite direction, as we saw here on this Alaska Airlines trade. Let's take another example here. This is on Halliburton, and I've got two pictures that I want to share with you here. Let's start with the one in the middle. You see where it says, yes, this is the confirmation. We've got a strong bullish move here, and then we start to see the weakness coming in. We're at the upper band. There's the tag of the upper band in the face of bearish divergence on your %B and your stochastics crossing down. This is a really good trigger right here. This one is very consistent. I've tested it. I've worked with it a lot. It's a very consistent setup that I'm showing you right here. And you short on the first strongly bearish day. If you want to add one more level of confirmation, take a look here and notice you've got an evening star candlestick reversal. So there's one more level of confirmation that, hey, this thing's really running out of steam. At the upper band there, you ride it down to the lower band, and here you have two opportunities. You could cover initially at about $52, and if you just walk the band down, it finally starts pulling away from the band down here around $48.50, $49. So again, you had a really good risk-reward trade. Now let me contrast this with another picture, and this is the one that's on the left where it says no. Take a look here. We're pushing into the upper band, but we do not have divergence on %B, and our stochastics are not even overbought yet. That's a no. You also notice if you look just slightly left, that is a squeeze that's breaking out. So one distinction that you could make, one observation, is you'd limit yourself. You say, I'm only going to do a reversal trade after I've already seen a big surge of activity. It doesn't make any sense if you're in a little squeeze like this to think, oh, I'm going to go do a reversal trade. Then you're looking for a head fake, not a reversal. The reversal is going to come after some momentum. If you look at this picture, you see we had the breakout here. We had a little trend trade for about a month or so, and then there's the reversal signal. That's the one you want to take. That's the one you're looking for. Now, the way this plays out is usually, more often than not, one of two ways. The way it plays out is either it plays out perfect, like I just shared with you here, and it trades to the other side of the band, or sometimes it trades sideways. More often than not, it's one of those two. It's pretty rare that you see this trade set up and then it turns around and it takes off in a new bullish trend. That's relatively rare. It can happen, but it's not the most common thing to happen. So this becomes a high quality risk reward trade where you got a high reward for the risk you're taking, and it's a fairly low probability that the risk is going to get fully realized. Usually you'll either break even or you'll see your reward on it. It's a very good trade setup, and as we start to do some back trading and some trader conditioning on this, you're going to see some of these as they come into practice here. Let's make some observations before we get over there, though. The reversal plays can be very profitable because of the quality of the risk and the reward. They do require some faith. This is one of the hardest things about the reversal trade is it does not look like it's going to do what it's about to do. And so it requires some faith. That's why it's really important that you go practice it a lot, do some trader conditioning on it, get really comfortable with it, and do some virtual trades with it. See if you can really get into the sync of it. It's one of those things, once you get into the sync of it, you'll be able to do them. But until you really believe in it, until you've done a few of them and you start to see them really work, you're always going to be kind of thinking, this doesn't look like it's about to reverse on me. And sure enough, that's about the one that will. But learn to do it, and it's a really good trade for you. Let's go do some back trading on this and see if we can really ingrain it into our minds what it should look like.